The Fed wants a recession and it's coming. Act fast. Do this now. That's what we're going to be talking about on today's stock market brief. Look, we're hopping right into it. I'm going to give you specifically what it is that I'm doing heading into this recession that we're most likely already in. And this isn't just the United States. This is global. And I'm giving you some very basic things that you need to act fast on, okay, with a sense of urgency. Let me walk you through some data, and then we're going to hop in specifically what it is that you should be consider doing. Take a look at the dollar. This is not actually from Friday. This was Thursday. On the last episode, we talked about the dollar coming into the top end of that weekly expected move. And how did it finish? Well, it got hit there on Friday's trading session significantly. So this could be a period of distribution. It could be a period of consolidation. As it stands right now, this is consolidation, despite seeing these big red candles, which can be a potential area of distribution. You might be saying, hey, why is this even important? Well, the dollar is an incredibly important asset to watch because it's correlation to other very important assets. So when this goes up, S&P 500 goes down. When this goes down, S&P 500 typically goes up, but it's a little bit more complicated than that. Okay, the dollar, this was a huge violent move in the dollar, and take a look what happened in other markets. If you didn't watch my recent video on oil, go back and watch it because we talked about this descending broadening wedge, and if it starts breaking out, it just did 5% in a single day. Understand that this has a huge weighting on inflation. People, if energy goes up, oil goes up, right? If oil goes up, the Fed's not going to like this. So if this starts going back into this range, what do you think they're going to do? You think they're just going to ignore that? Of course not. So the dollar came down, oil shot up, but it wasn't just oil. Take a look at gold. Gold shot up massively, and we talked about that on the prior episode, saying if the dollar comes off, watch for gold. Now, gold is still in a downtrend, but up 2.8% in a day is huge. Look at silver, up 7% in a single day. I know a lot of technicians will be looking at this and saying, hey, it's a potential diamond bottom. We're off to the moon. Dollar's going to come down. This is going to continue to ride. Well, we also saw a big move over here, and then we saw it followed by some strong moves to the downside, and same right here, strong moves to the downside. So, we're not out of the woods yet by any means, but it wasn't just there. Let's take a look at miners. Miners have the very similar pattern because why? Well, they track almost 1-for-1 correlation to silver. Another one to watch is Dr. Copper. So people are all paying attention now, right? As soon as, isn't that funny, right? We talk about expansion leads to contraction, contraction leads to expansion. Well, you just had a 7% move in the price of copper. Yeah, the dollar dropping that hard definitely helped this out. Okay, this is an explosive move. Now everyone is talking about it. Go figure. People, you got to understand, it gets quiet in periods of contraction. It gets very quiet in periods of contraction, and then when expansion comes, then it's on the news, okay? That's when people talk about it, and that's when we need to be prepared. So is this going to break out and continue to head higher? Do you really think the Fed is going to enjoy seeing the price of copper start to rip up along with the price of oil? Absolutely not. And I'll show you why here momentarily. Take a look at copper miners. Copper miners were up almost 10%. That is a gigantic move. Copper miners, it's coming into a prior area of resistance. Honestly, personally understanding what the Fed is trying to do in this environment, these are actually looking like short opportunities, in my opinion here. Now, with all that said, what do we got coming on to next week? Well, we have Fed speakers, we have 2022 midterm elections, we got a big report coming out on the 10th. What is that report? The inflation report. So if energy, oil, and all these prices around us continue to rise, right, including the stock market, do you think the Fed is really going to slow down all of a sudden out of nowhere when it's on a path to try to bring inflation down? In my opinion, no. Can something change? Can something systematically break? Obviously, and that could always change the perspective of what the Fed is doing. But as it stands now, at the very last meeting, they were hawkish, right? They put out their notes and everything seemed fine. People got excited. But then when they were asked specific questions about, do you like seeing the reaction in the market right now? Do you like seeing the market, the bonds go up? And all of a sudden, Jerome Powell just, became, fiery red eyes and just shot it all down. So we have inflation coming up. Is that going to come in hotter than expected? Is it going to continue to, reduce itself? I guess if we take a look at inflation rate year over year and core inflation, we have consensus right over here. So is it going to come in hotter or cooler than expected, right? We've already discussed inflation already peaked potentially, but we don't know. If you take a look over here, it's at 9.1 was the high. Is that the peak? Well, it's been in the 8s. That's far off their target of 2%, okay? So understand once again, this is not good. It's not good. So we need to prepare ourselves for a recession. You got to understand that is what the Fed is trying to do. Now, look at the target rate. The target rate was moved up, right? It's at 375 to 400. Now, coming into February, right? So we have December, which is probably around a 50 basis to maybe a 75 basis point hike. We will see, including what the data comes in. This is going to change dramatically. When the CPI report comes out, if it comes in hotter than expected, I have a strong feeling that this is all going to change dramatically, okay? But if we take a look here, current target rate is at 375, okay? Just going out to February, okay? We're looking at a 50 plus 30, that's an 80% probability of being anywhere between 475 to 525, okay? That is that's 100 basis points or higher in a shorter period of time. So the terminal rate, right, it's looking more towards 5%, maybe even, north towards 6. Who knows how high we can go? You got to understand the environment that we're in. Now, what does this cost? Let's take a look at the Fed's fund rate, okay? I want you to really understand this before we get into how do you recession-proof yourself. So first and foremost, when the terminal, or when these Fed funds rates, when it goes down, what does that encourage, okay? When interest rates are low, what does that encourage? It encourages people to spend money that they don't really have. And when they spend money that they don't have, what are they getting? Well, more expensive products because they can afford the payments. They can't afford the product itself. So for example, a house, right? So if you take a look at a house, okay, boom, 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 here's my house. It's a median home, right? If we actually take a look at the price of median homes right now, I'll pull that up, median home. In 2022, it's above 440,000 there. That's pretty high. It's October 26, right? I have a feeling this is going to come down, but let's go back over to the interest rates over here. So as prices come down and they're held low, well, home prices are typically, they drive upwards, okay? We saw that here in 2020, right, to 2022. All right, we saw these flat rates right here. It caused a huge housing boom, right? We saw the whole COVID thing and prices just skyrocketed, right? Now what we're starting to see is the rate go up. So interest rates are going up. What does that encourage? Well, it encourages people to slow down their spending and lean more towards savings. All right, now savings is important if you have savings, but you got to understand the savings rate right now, the personal savings rate, is near an all-time low. Now, what do you see happen in recessions? Well, you typically see spikes. This is even a recession. So when the recession actually hits, when something dramatic happens, then people start saving. You want to get ahead of that. You want to have savings ahead of time, because if you want to prosper coming out of a recession, you need to have funds prepared. Now, you can also see this if you just go to like any website. I'm using Capital One. I'm not sponsored by them by any means. I have a Capital One account. But right now, their 360 performance saving, as heck to set up. It's at 3% APY. 3%. All right. So if you have just cash sitting around, maybe an emergency fund, whatever the case may be, they're paying 3%. Also, you have I-bonds. They're still around 7%. Just last month, it had the record issuance, like 5 to 7 billion, I-bonds. It's crazy. And it was at 9%. Okay. It's still at 7%. You can only do up to 10,000. You got to keep it locked up for about a year. Okay. So if you're, want to move money in and out faster, I'd say, savings like this would be a little bit better. All right. I'm going kind of on a tangent here, but let's go back to housing, right? So if you take a look here, when rates were below 3%, it caused a huge refi boom and prices of homes completely skyrocketed. And now what? Well, the rate of change on the 30-year mortgage, it's moving like crazy. The rate here is at about 7%. We haven't seen that since what? Early 2000. But if you once again look at the median price of a home, has it even been affected? Look at this. Watch right here, 2020, okay? Then let's go back over here. Okay, what happened here going into 2020? Rates were reduced, and then home prices, they skyrocketed. Now, rates are going way up, and have you even seen anything happen to the median price of a home yet? Well, I have, if you look deep into the data. And what I'm starting to see here, if you look at Redfin weekly housing data, price drops are actually increasing. Now, what I find interesting is they're increasing, but if you compare it to these prior years, this is actually where they typically go down. And what we're seeing here is this go up. Okay, so the amount of price drops, this is percent active listings with price drops. Okay, about 8%. So 8% of active listings are dropping the price of their current home. Now, what I find even more interesting is if you take a look at age of inventory, coming into this period of seasonality, you typically get increased time frames of houses on the market. So if the age of inventory is going to be increasing and people want to get rid of those homes or sell those homes, what do you think they're going to do it? Well, we can see continued price drops. And what does that mean? Well, we could see very well the median cost of home go down. And if the median cost of the house goes down, you got to understand that most Americans and most people's, their net worth is tied up in their home. Okay? So that's where the wealth effect comes in. And that's where the thought of recession comes in. If you can, reduce the wealth effect, if it comes down, right? And Americans and people feel, less likely to spend, right? What do? Well, they spend less money, right? And that is what can cause a potential recession. And when we're looking even deeper into this, you look at the Fed balance sheet, and the Fed balance sheet currently, they're winding it down. You can see here, it's dramatically dropping, right? It's still really high, but you got to understand when they drop it like this, what do you think happens to the stock market? Okay. Well, the stock market tracks it very well. Take a look here. When they were tightening over here in 2017 down to 2019, what did you see take place? So you saw a lot of volatility in the market. Okay. And then all of a sudden the market got hit, and what did? Boom, we shot off cannons, bazookas, right? And now we're starting to tighten it up here. And what do you see taking place? You're seeing massive volatility in the stock market. So the Fed is continuing tightening. They're raising their rates. Of course, the recession is going to come. Okay, and how bad it's going to be, I don't know. But we don't need to worry about how bad it's going to be. What we need to worry about is what we got to do specifically in order to protect ourselves during a tough time. Okay, now let's get into the S&P 500. Then we're going to talk about those things. But if you take a look at the S&P 500, incredible amounts of volatility, still below a declining 200-day moving average, right? We have this trend line here. Can it potentially reach up to it? Does that mean we're out of the woods? Nope. That means we're just making another higher low or lower high, okay, and another series of lower lows. All right, so we have about an expected move roughly, actually, no, it's $116 expected move. I'll actually show you the screenshot of the expected moves momentarily. But what I will call out here, this kind of pullback here, and we're heading into a seasonal period where we typically get, decent bullish activity. So you can't rule out the move to the upside, okay? If we get a move to the upside, the weekly expected move is right up to here. The downside is right down to here, okay? Now, if I take a look at this little trend line here, we have this little inverse head and shoulder, right? Boom, boom, little shoulder right there. Slanted neckline, it came right down, and we started to bounce from it. If you remember on yesterday's video, or Friday's video, or Thursday's video for Friday, or whatever the case was, I discussed that everything was oversold, and I showed you many big mega cap names. Okay, so to see some sort of a bounce means we're just, that's what happens, right? Things sell off, and you don't need a real reason as to why they bounce other than they sold off. It's not that complicated. If you take a look at the SPY, this is incredible amounts of volatility right here. And why? Well, we're back into the chop box, right? We've been talking about this range right over here in the SPY where we just get aggressive swings back and forth and back and forth. And now when we get back down there, we're right back there again, okay? We closed just about at the weekly expected move from last week. You can see a little bit more clearly here. We are below this. That's this week's. We're below a declining 5-day moving average as it stands right now. So be patient, right? The trend is currently down until proven innocent. We want to get above these areas, right? So as it stands right now, this is, just getting chopped up, building open interest in a, area that can just bring on more volatility. And if you don't believe me, look at the 1 minute time frame. Look at how volatile of a trading session this was. We opened up, strong move to the downside, strong move to the upside, strong move to the downside, strong move to the upside, strong move to the downside, strong move to the upside. I don't know what to tell you. This is an incredibly difficult market to navigate. Something really does feel broken here. So you need to protect it yourself. If you're trading, you need to navigate this tactically as best as you can. And as it stands right now, I look at weekly expected moves. I look at the zones, right, for the Patreon group, and we determine, okay, so should we be shorting right here or should we be backing off, right? It's all about, look at, if it doesn't matter what time frame this is, but just a lot of people typically say, oh, it's crashing, let's short, and then they short right here and then it starts moving up. Okay, a lot of other people see this and they're like, oh, yep, nope, we're going, it's good, and then they get FOMO, right? They start going long right over here, and then it drops on them. So my point is this, like in these bear markets, you need to be tactical and you need to be patient. You don't just chase moves up, and you don't short into the hole. We need to use our indicators, our signal charts, stuff that I share in the Patreon, stuff that I share here for absolutely free. If you're new here, well, this is what I do. I use technical analysis, intermarket analysis, make sure to thumbs up the the button if you haven't done so already, okay, and subscribe to the channel. Let's take a look at the Qs. Qs is at the lower range of its chop box. You can see here, this was CPI day, and then now it's right back to where, you know, the prior chop was, right? So nothing's changed. As it stands right now, we can still very well be carving out an inverse head and shoulders. This was pretty nasty. We're below a declining 5-day moving average. So what does this mean? The bears are in short-term control. And surprisingly enough, not surprisingly enough, they're in long-term control because there's a series of lower highs and lower lows, okay? All right, so let's continue on. A couple other things to watch, including with the Qs, is obviously the 10-year yield. 10-year yield closed at 41.56 on the TNX, which equals 4.15%, right? We broke out of this. So if this wants to fire off to the upside, yeah, that can easily, especially with a rapid rate of change, watch out, watch yourself, because tech can get hit. Now, if this also starts, you know, holding up or start to rise, I think that financials are going to get hit here. I talked about that on a few episodes ago, and I pointed out some, you know, technical perspectives to it, and then how they just haven't been affected. I still think that's going to be a very important sector to watch. TLT, which is Treasury bonds, right? If you take a look here, this got completely crushed, down 1.68%. You typically have a flight to safety with Treasury bonds. We have not been getting it, and we're still in a downtrend, okay? So if this thing starts getting hit more to the downside, the 10-year yield rises, watch out, because it's going to get more violent. More violence is coming. And then if we take a look at the inverted yield curves, they're still inverted, right? Almost 50 basis points on the 10 and 2, minus 4 basis points on the 10 and 3 month. This is not good. It's not good for financials. It's not good for the markets. We have a recession coming, so how do we proof ourselves? Well, that's going to be on the next slide, but screenshot this. This is the SPX, the SPY, the Q, the IWM, and the Dow Jones, the diamonds. These are the expected moves right here. That's plus or minus, going to be moving this much next week. This is what the options market is pricing in based off implied volatility, and these are the levels. So we have I'll just draw it out. So this is the lower level, and this is the upper level for the weekly expected move. You can put those on your chart. And this one right here is plus or minus. So there you go. Screenshot it. And this right here is where the price closed on Friday. Okay. So you got closing price, plus or minus, upper, and your lower levels to pay attention to. Okay. Now, if you want more of these, I track like 40 of those products on the Patreon group, which is a link in the pinned comments or the description. Okay. So here we go. How do you recession-proof yourself during this time? It's very simple. It's probably things that you've already heard of, but here's the reality of it, and I'll walk you through my thought process. And it kind of goes from, you know, most important to, you know, it's still important, but I'd say the number one thing is to obviously increase your income. That's going to be the most important aspect in all of this, and you have to act with a sense of urgency right now. How you increase your income, I don't know. It doesn't really matter. Just do it, as long as you're doing it ethically, right? So if that you know, sell some things, you know, work extra hours, get another job, do what you need to do to increase your income, especially if you have debt, okay? The next thing is to focus on expenses. So cut unnecessary expenses, tighten up your budget. If I don't focus too much on your budget, no one enjoys this. No one got rich by focusing heavily on their budget. They got rich by increasing their income. That should be your number one focus. Saving money at Starbucks is not going to make you rich as much as you think it is. This is going to actually really provide you that extra boost you need. So increase your income, and then obviously, yeah, cut unnecessary expenses. You know, get a budget, focus on your, you know, monthly expenses, the ones that are recurring, and kind of hone those in a little bit. The next piece to all of that is start eliminating your consumer debt. Get rid of it. Just get it off the books. During a high interest rate environment, you don't want to pay interest rate on this kind of stuff. And in a recession, this is going to hold you back. I promise you. The next thing, obviously, an emergency fund, 3 to 6 months at most. It's important. It's including if you lose your job, you need this, all right, and you need it to also pay down debt if you lose your job or make, you know, paid certain expenses. So if you don't have that, start to build that up. One of my favorite here in a recession is having an opportunity fund. Understand that we're in the financial crisis, the great financial crisis of 2008, right? Remember, there was a huge spike in savings when the recession came, right? They weren't spending money, so the savings rate went up. Well, the people that actually had an opportunity fund and had savings prior to it got to buy amazing deals. They got to take advantage of opportunities in the marketplace, both in the stock market, both in real estate, both in businesses, right? Big, huge opportunities came coming out of a recession. And you got to understand, recessions will bring monster opportunities. Okay, it's going to bring obviously a lot of pain and heartache for a lot of people, but you got to understand you can't worry so much about the economic effects before you worry about your own economic household. So worry about yourself first and get your house in order so you can provide and do more opportunities out into the future. And that could be an opportunity to just give to charity. It could be an opportunity to serve more. It could be an opportunity to do all kinds of things, okay? So the list is endless there. And then obviously invest would be another one. Now, this doesn't just mean invest in your stock market portfolio, your 401k, your Roth IRA, or whatever the case is. This is also investing in yourself. You got to understand, if you want to recession-proof yourself, you need to make sure you have the skills coming out to come out of the recession and really benefit from any new trends. Okay, so invest in yourself to acquire skills that are going to eventually increase your income. That's all I got for you on today's episode, everybody. I hope it helped out. See you on the next.